So first off, what is Forex? Forex is the largest and most liquid market in the world, and it trades on average about $6.6 trillion per day. Now, what that means for us as traders is that we're never gonna have a problem getting our order filled. Forex is a global marketplace for exchanging national currencies. And the way we use this as traders is that in Forex, we're trading based on something called a currency pair, which we'll talk about in a second. And this currency pair is nothing more than the exchange rate between two different countries. And this exchange rate fluctuates up and down based on the different strengths and weaknesses of an economy for a specific currency, along with many other factors. And as traders, we use information that we gather from technical analysis and fundamental analysis along with news events in order to predict these fluctuations in prices and trade accordingly. Now, as I just said, Forex is traded in something called a currency pair. So the very next thing we're gonna do is take a look at what is a currency pair. A currency pair is exactly what it sounds like. It is two separate currencies in a pair, and we use this currency pair to determine the exchange rate of two separate currencies. To make this more clear, you can see on the screen, we have the Aussie dollar, and what I'll do is I'll also put a screenshot of every three-letter abbreviation that equals a specific currency on the screen somewhere right now. And these three-letter symbols, again, represent a specific currency. So in this case, we have the AUD, which would be the Australian dollar, versus the USD, which would be the United States dollar. In a currency pair, the first currency in this pair is what is known as the base currency. And the base currency is always equal to 1. The second currency in a currency pair is what is known as the quote currency. The quote currency is the quote you actually see on the screen. So the way to look at this is it takes one Australian dollar, and if I have one Australian dollar, I have roughly 0.6504 cents of United States dollar currency. So that means it takes roughly 65 cents USD to equal one Australian dollar. So in this case, I want to ask you, which currency is stronger at this moment? Well, if we only need 65 cents USD in order to equal one Australian dollar, then the USD is stronger than the Australian dollar at this moment. Let's do this one more time with another example. On the screen, you can see that we have the euro versus the dollar. So if we have euro versus dollar, which one of these is going to be the base currency? That's going to be the euros. That means the euro is going to be equal to 1. Then we have the dollar, which is what? It's called the quote currency. Since the dollar is the quote currency, that means it takes $1.0713 USD to equal 1 euro. So let's go ahead and put that down. We have 1.0713. I know my handwriting's awesome. And so now we know that the euro is stronger than the dollar at the moment because it takes us 1.07 or $1.07 to equal 1 euro at this moment. And for a last example, I want you to do this one completely. Which one of these in the CAD yen is going to be the base currency? Now, which one's the quote currency and which one is represented by this number? So hopefully you said that the Canada was the base currency. Hopefully you said the yen was the quote currency. And hopefully you said the 102.63 was how many yen it would take to equal 1 Canadian dollar. Now let's move on to brokers. So what is a Forex broker? A Forex broker is just a financial services company that acts as a middleman between us as traders and the Forex market itself. It's how we actually place trades. Now, in terms of Forex brokers, there's plenty of options out there. The only things that I'm going to say here is that you want to make sure you find a regulated broker that's regulated in a country you've heard of. So not a broker that's registered and regulated in the Cayman Islands. That's something you would not want because there you're running the risk of that broker shutting down, going bankrupt, and you losing all of your money. So you don't want to find a broker that's either not regulated or not regulated in a country that you have heard of. But as long as you have a broker that's registered and regulated in a country you've heard from, you're probably in the clear. The other thing you want to look out for is you want to find a broker that has competitive spreads. Spreads are how brokers make money. Some brokers are going to have higher spreads than others, so you want to make sure to find a broker that has competitive spreads. And outside of that, this broker is going to need to cater to your own personal needs, so it may be different for everyone. For me, my personal broker is Owanda. They're not sponsoring this video. I don't have any kind of affiliate link with them whatsoever. I've just used them forever, and it's who I use right now. Feel free to check them out at owanda.com. Now, your broker may have a trading platform that comes with it, but they're normally not that good. So the next thing you're going to need after a broker is an actual trading platform. You've probably heard of MT4 and MT5. My favorite, though, is tradingview.com. So this is my trading platform that I use on a daily basis. It's an online trading platform, meaning you don't have to download anything to access it. And it's got everything anyone would ever need. It's got every indicator you can think of. It's got all different types of tools that can help you make trading as smooth as possible, which is very necessary in my opinion. If you want a full tutorial on this platform, I'll put it in the top right corner of the screen along with in the description. I made like a 20-minute tutorial that goes through every part of TradingView and teaches you exactly how to use this trading platform. If you're interested in that, check out that video. But one of my favorite parts of TradingView is that I can connect my broker to this trading platform, and I don't have to switch back and forth between my broker and my trading platform in order to place actual trades. So right now what I want to do is show you how to connect your broker to TradingView if this is something you decide to do. Also, feel free to check out TradingView by going to www.tradingview.com. So in order to connect your broker to TradingView, all you need to do is come down here to Trading Panel. You can make this as large as you want to. I hit see all brokers, and at this point, just look through the list of brokers that are available in your area and make the decision on whether or not you would like to connect your broker with TradingView. Now, if your broker is not on this list, that simply means that they cannot connect with TradingView at this time. And you'll have to find a different trading platform or do as I used to do and go back and forth between your trading platform and your actual brokerage account in order to place trades. So now that you know a little bit about brokers, trading platforms, and how to connect a trading platform to TradingView, let's move on now and talk about what is a pip. So a pip is how the Forex market moves. It stands for percentage in points. And what's really important for you to understand is what a pip is. A pip is the fourth place after the decimal. So right here, we're looking at the euro dollar. This is the important part. What you really need to understand is that a single pip is the fourth place after the decimal. If we go 1, 2, 3, 4, which one of these numbers is a pip? The fourth one, so the 9 here is 1 pip. What that means is that if we go from 1.0709 on the euro dollar to 1.0708, we have now went down. The price of the euro against the dollar has went down 1 pip. So that's how you calculate and find a pip, and how much prices move is based on these pips. So let's go ahead and do another example here. What if we go to 1.0809? At this point, how many pips has price went up? Well, we've went up 100 pips. So the 9 is the ones, the 0 here would be the tens, the 7 would be the hundreds. That's how we calculate everything. Let's do 2 more examples really quickly. It's just easy math, so you should be able to get a hang of this pretty quickly. What if we go to 1.0710? How much did we go up? We went up 1 pip because we went from 09 to 10. One more example here. What if we go to 1.0701? How many pips did price move lower? We moved lower by 8 pips because we went from 0.9 to 0.1, meaning we went down 8 pips in this example. Now, this 4 decimal point to the pip is true for every currency pair except yen crosses, except pairs that have JPY in them. So what we're going to do now that you understand a regular currency pair in terms of pips, where the pip is, and how to determine how much a currency pair went up and down using pips, let's now take a look at a JPY pair and where the pip is on those pairs. So as I said, on a regular currency pair, everything but yen pairs, the pip is going to be the 4th place after the decimal, which means we can't have that on a yen pair because on yen pairs, we only have 2 places after the decimal. So for yen pairs, the pip is the 2nd place after the decimal. So 1, 2, that would mean the 6 right here is the pip counter for the dollar yen. So if the dollar yen goes from 139.96 to 139.97, how much did the dollar yen go up? It went up by 1 pip. Let's do a couple more examples. What if we go to 139.86? How much did we go down? We went down by 10 pips. So now that you know what a pip is and how we can determine how much prices of a currency pair have went up and down by using pips, what is a pip worth? How to calculate the value of a pip is what we're going to take a look at right now. While in a trade in the Forex market, as the market moves up and down, we're obviously making and losing money depending on what position we have on. Now, with the market moving in pips, we need to know another side to this equation to understand what the value of each pip as price moves is going to be